Today, we are diving deep into two pivotal concepts: liquidity grabs and break of structure. Understanding their differences can be the key to avoiding traps set by smart money and enhancing your trading strategy. A liquidity grabs occurs when the price momentarily breaches a key support or resistance level, triggering stop loss orders and then swiftly reverses. This move is often orchestrated by institutional players to accumulate positions at better prices. Understanding break of structure. A break of structure signifies a genuine shift in market structure where the price breaks a previous high or low, indicating a potential trend, continuation, or reversal. Recognizing a break of structure helps traders align with the prevailing trend. What are the key differences between liquidity grabs and break of market structure? The intent of liquidity grab is to trigger stop loss orders and reverse price, while break of structure indicates a genuine trend continuation. When it comes to price action, in liquidity grab, you see a sharp spike and a quick reversal. But in break of structure, you see a sustained move beyond the key levels. Liquidity grab often accompanied by a volume spike, while break of structure has consistent volume supporting the move. With liquidity grab as a trader, you have to wait for confirmation before entering the trade. While with break of structure, you have to align your trades with a new trend. Practical tips to differentiate between liquidity grab and break of structure. Wait for confirmation. After a suspected liquidity grab, wait for a candlestick pattern or other indicators to confirm the reversal. Let me show you a real life example. Here is XAUUSD, and you can see this is a clear bearish trend. If you look carefully, you can see that price previously has formed support around this zone, and after that it rallied up, then came back to this zone. And what happened? Price broke through this support and came to this level, after which it swiftly reversed and formed this bullish candle. You can see the wick here. You can see the whole candle. This is what we refer to as liquidity grab. The extent of it is to just come down here and trigger all the stop losses around this zone. Then they will have enough liquidity to push the price higher. And let's look at the subsequent candle. You can see bullish candle. Then what happened? Price continued up. So this terminal bar was to trigger all the stop losses that was here, and after that we have this bullish rally. This is what liquidity grab is all about, is to create more liquidity for the smart money, the big banks and all, because they have what it takes. They take off all those who were previously in this trade. Those, by seeing this candle, some people will think that the price will start heading down and they will sell. Immediately they sell, then price reverses. And those who bought when price was around this zone, they will think that the price will start heading up. But what smart money does to them is that they trip off their stop losses before reversing the price. So this is what liquidity grab is. The next thing you have to do is to analyze volume. A genuine break of structure often has a consistent volume, whereas a liquidity grab may show a sudden spike. So this is a sudden spike. Now let's go into an example of break of structure. So here is a USD card on a daily time frame, and if you look at this, we are in a downtrend. After that, price formed a double bottom. And one thing with A double bottom is that it's a reversal pattern. And after this dip, you can see price rallied and broke this trend line. You are considering the wick here. You can see the breakout candle, and you can see how uniform, not like a sudden spike that we saw in liquidity grab example. It's not like this sudden spike. This is another liquidity grab. You see price just pushed up to take out those who may have sold at this point, and after that it reversed, and you can see it came all the way down here. But at this point now, price is trying to reverse, and you can see this breakout, not a spike. So this is a breakup structure, though it has not been confirmed yet. But immediately this last swing low is taken out, it means this resistance that was formed here has also been broken. But as it is now, this trend line, considering this trend line, it has been broken here, and you can see another confirmation that this structure has been broken. You see where price closed? It closed a little bit above this resistance here, and if you consider watching it, you see another bullish candle, and you see this is how you identify breakup structure. You see uniform volume of candle formation. You don't get to see spike like this. So when you see a spike like this, the next thing that should come to your mind is this is purely market manipulation. But when you see consistent candle, is simply a breakup structure, and it's not a manipulation. It shows you that at this point, bulls have taken over the market, and what you should do is look for opportunity to enter this trade. Sometimes when you see this, you can enter immediately, but if you are a conservative trader, you wait for a retest. But at this point, there wouldn't have been an opportunity for you to enter a retest, because immediately there was a breakout, price continued up. So these are the major differences between breakup structure and liquidity grab. Distinguishing between liquidity grabs and breakup structure is crucial for effective trading. By understanding their characteristics and using confirmation tools, you can make more informed decisions and avoid common pitfalls. I already have a video on liquidity grab with how to enter a trade and how to avoid it, so check the link in the description. Also check out our Telegram channel for free signals. If you found this video helpful, please like, subscribe, share it among others. Thanks for watching, and I'll see you in the next one.